All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So today we're going to be talking about a little bit of a contentious subject. Can an IUL be used for infinite banking? And the answer is quite simple, so stick around after the intro and I'll break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. I specialize in designing high cash value, maximum overfunded life insurance policies that real estate investors can use for leveraging to make their real estate purposes. The double play allows real estate investors to literally put their money to work in two places at one time. But the question is, what kind of policy should you use? Should you use a whole life or should you use an indexed universal life? And quite honestly, you can use either one. The infinite banking folks might tell you that it's got to be whole life from a dividend paying mutual company that's been around for a million years. But it's important to understand that all life insurance policies are built on the same exact chassis. They all share the same mortality costs. They all have the same mortality tables. And the only way that they differ is really downstream, where it comes to the point of paying a dividend. They all invest their assets. All of the premium that you pay into a life insurance policy gets dumped into their reserves, and the reserves get invested in bonds and mortgages, preferred stocks. They make loans, and at the end of the year, they have interest income. And in the case of a whole life, your share of the gain on the net gain, I should clarify, on the insurance company's reserves is what's credited to each policy as a dividend. In the case of an index universal life, the only difference is what would have been the dividend goes out to their team of hedgers who purchase options on various stock market indices with the goal of trying to capture as much movement in the market as they can get with the budget that they have to spend. So what they're looking for is an opportunity to do a little bit better than what they would have done had they just simply paid a dividend. Now, it's important to understand I don't have any horse in this race. I sell life insurance policies that are best suited for my clients. I'm not a whole life guy. I'm not an index universal life guy. But I do take issue with both sides when they tell lies about the other side's products or they misrepresent how the other side's products work. At the end of the day, like I just said, the products are pretty much identical except for the way that they credit interest. So with a whole life, you can expect to see a constant dividend year in, year out for the most part. Remember, their portfolio of investments is generating interest, and that interest is being credited to each policy. So you can expect something being credited to your policy every year. Interest rates may go up, interest rates may go down, but it's going to be consistent every year. In the case of the indexed universal life, you can expect a variability. Over a long period of time, you should expect that the indexed universal life might do a little bit better, should do a little bit better, because they're hedging with the options on the various stock market indices. But when you're in years where the stock markets go down, well, those options on the index are going to expire worthless, and you might just have a year where you don't get paid any dividend. So it's also important to understand that the infinite banking folks don't typically design what I call a maximum overfunded life insurance policy, one where the death benefit is absolutely minimized and you can't put any more cash into it. Instead, they use the illusion of paying yourself interest. But it's important to realize that that interest is actually just paid up additions, premium, that's being paid into the policy at a later date and time. That's premium that you could have put in up front. So let me just ask you a question. If you're putting in, let's just say $100,000 of premium each year, that might just be for 5 years. Do you want 85% of your premium going to the cash value so that you end up with $85,000 of cash value that you could turn around, borrow, and invest in real estate? Or would you rather have 65% of your premium going to cash value with only $65,000 available to invest in real estate? The latter, while being lower, gives you the opportunity to pay interest to your policy in the form of paid up additions. So you could get up to that 85% level of funding. But if your goal is to invest in real estate, it makes much more sense to, if you can only afford a lesser amount of premium, then design the policy around that much premium and have it be maximum overfunded. The infinite banking folks don't typically design policies that are maximum overfunded. They're overfunded, but they're not maximum overfunded. There's always room to put more in. So the only time that I would ever design a policy that's not absolutely maximum overfunded is when I'm dealing with a younger client who is new in their job and they might have the opportunity to see significant increases in their ability to pay premium down the road. So I might design a policy that allows for them to increase their premium over time. Conversely, real estate investors, I mean, if you're expecting a liquidity event, you're selling a property in a few years and you want a place to dump the cash so that you've got access to it inside of a life insurance policy, there's a case where I might design a policy where you're paying a little bit less, still getting a high death benefit that will allow for more premium. And just later on down the road, whenever you have that liquidity event, then you've got a container that you can essentially dump dump cash value premium into the policy without creating a MEC, a modified endowment contract. So those are the only two situations in which I would do it. Typically, most clients, I'm going to design a maximum overfunded life insurance policy, one where the most cash value is coming out of each premium dollar that you're putting into it. So just to wrap up, the choice between an index universal life and a whole life really comes down to the comfort level that you have with the way that each policy pays dividends. Whole life policies typically have higher guarantees and pay much more consistent dividends year in, year out. Whereas index universal life might work out to be a higher overall rate of return down the road, but you're going to see year to year variation in those returns. And I also think that it's important to understand what I call the gimmick of infinite banking, which is the illusion that you're paying yourself interest. Just understand that that's not interest you're paying yourself. Those are paid up additions. That's premium that you're putting into the policy at a later date. You're saving room to add premium later when you could have put it in upfront and had more cash that you could have borrowed rather than tricking yourself into believing that you're paying interest. And again, the only time I would use a non-optimized policy is just if I'm building a container that can add more cash value, more premium to it later on down the road. So I appreciate you tuning in. If you need help in designing a maximum overfunded life insurance policy, by all means, find my contact information in the description box below, and I'd be happy to help you out. Thanks for tuning in.